In the last month, SoFi has experienced some serious volatility. The stock is traded in this range of $25 to $30. But in my opinion, this is very healthy for this company because over the course of the last year, we have seen the stock move up by over 160%. And over the last couple of earnings announcements, we have seen very solid gains as the stock has moved up after these positive reports. This is vastly different than what we saw just a few years ago where SoFi would run up into earnings and then go on a massive dip immediately after earnings were announced. What we are seeing right now with this volatility in SoFi's stock price is investors trying to interpret what is going to be announced for Q3 in terms of earnings. And right now, SoFi is set to announce those earnings on Tuesday, October 28th, before the market opens. And analysts are expecting that SoFi is going to put up around 8 cents of EPS for this quarter, with revenue coming in at $893.47 million. That would be up about 30% year over year from $698.45 million in 2024. And honestly, these numbers should come at no surprise because they are right in line with what SoFi guided in Q2. What they guided for the rest of the year is that the company is going to put up around $3.375 billion or 30% growth year over year, and EPS numbers were going to come in around 31 cents. So far, the company has put up about 15 cents of EPS for this year, which means over the next 2 quarters, they need to average around 7 to 8 cents of EPS. Again, just in line with what analysts are already expecting. But what I will point out is that at the start of the year, SoFi was only expecting revenue growth of 24 to 27%. So through half of the year, we have seen these estimates already start to climb, and that is also true for their bottom line numbers. At the start of the year, they were expecting 27 to 28 cents of EPS. Again, that has grown to 31 cents since that announcement. So we are seeing some positive momentum in the upward direction, with SoFi actually beating their previous guidance. And the reason I point all of this out is because clearly in the past, the company has sandbagged their numbers. And the fact that analysts are leaving their numbers in line with what the company is expecting really offers the opportunity over the next couple of quarters for SoFi to come through and beat not only their own, but also analysts' expectations. And that is something they have done consistently over the last 4 quarters. And in the last 2 quarters, they have beat analysts' expectations by 94% and 45%. I personally think that SoFi is going to put up somewhere between 10 and 11 cents of EPS, coming through with a nice beat compared to what analysts are expecting. And a lot of the reason for this is because of the company's shift in focus to fee-based revenue. Year over year from 2023 to 2024, we saw growth in this revenue of 74%. And I think what we are going to see in Q2 of 2025 is again a nice solid 70 to maybe even 80% growth of this fee-based revenue. It's becoming an even higher split of their total revenue. Right now, we are seeing 56% of their revenue come in from all other revenue sources, with 44% of their revenue coming from fee-based revenue. And really where all of this revenue is coming from, this fee-based revenue, is them originating loans for other companies. Basically, they will take their customers, they will create a loan for them, and then they will sell off that loan. That is good for SoFi because they don't have to hold that loan on their balance sheet. And overall, that becomes a more profitable approach, which increases their margin. And this is why we could see EPS growth over the next year really start to take off for this company. I do want to caution investors though, because what we have seen over the last probably 3 years, really since 2022, is a focus from a large number of companies to increase their profitability and really focusing on their bottom line numbers. What that could result in over the next 1 to 2 years is a shift in what is important for investors. Because the last 3 years have been focused on profitability, we could see this shift into focusing on growth. This is similar to what we saw in 2020 and 2021 when a lot of these growth companies took off in a massive way. And SoFi was one of those companies during that time period. However, they had to shift their business into focusing more on profitability. So if we see this shift back into focusing on growth, that could actually result in some downward pressure for SoFi because over the last few years, they have not had a focus as much on growth. Their member growth is now sitting at 34% compared to a couple of years ago when they were growing members by 51%. And that's not to say that SoFi is not going to grow in this next phase. The problem with growth markets is investors tend to focus a lot on vanity metrics like member growth. We saw this occur with Netflix a couple of years ago when their member growth was decreasing. However, the company shifted their focus into profitability and they saw their stock take off in a huge way. But that also coincided with this focus from investors on making sure that they were going to invest in profitable companies. If we see interest rates drop in a huge way, what could shift is investors could focus more on companies that are growing some of these vanity metrics and taking on a lot more risk across the market. SoFi is kind of shifting into a lower risk business, which for the long term should be a good thing, but could show a little bit of pain in the short term. And really, by pain, I'm not even talking about huge decreases in SoFi's stock price because right now it's not severely overvalued. The forward P ratio is sitting at a 47.17, and this is a company that's growing their bottom line by 50% and could do that over the next few years. What I mean by pain is this could be a stock that instead of returning hundreds of percent each and every year, we could see it only go up by 20-30% over the next couple of years. And these are still returns that should outperform the broader market. However, SoFi is shifting into a company that should provide performance that is a lot more in line with their overall EPS growth. And for 2026, EPS is expected to come in at 53 cents. On the low end, analysts are expecting 42 cents. On the high end, they have an estimate of 60 cents. Right now, when I look at these estimates and look at the low end estimate of 42 cents, I think that a fair PE ratio could be anywhere between a 25 and a 35. That would result in a much lower stock price. And that is based off EPS growth of 31% year over year. To me, I think that SoFi should easily beat these numbers, but 31% growth year over year is still solid. If we just see a contraction of the overall valuation of SoFi, that could result in a major drop in the stock price. To me, I just don't think that this is going to happen. I think it could if we have a bad environment in the overall market, but I don't think it's reasonable necessarily to occur. For the inline estimate of 53 cents of EPS, that would be 65% growth year over year. At that point, we should be able to see SoFi maintain a valuation of around a 50, maybe even a 60 forward PE ratio, which could result in a stock price between $26 and $31 per share. That basically is telling me that right now, SoFi is trading at a reasonable price. Then at the high EPS estimate of 60 cents, that would be growth of 87% year over year. What we could see is a valuation between 55 and 65. I don't like projecting valuations of over a 60 for a forward PE ratio. I've talked about this before on the channel, but what a lot of investors, especially value investors, have found over the years is that companies can hardly keep up with a 60 forward PE ratio. That can be very difficult for them to grow into. One of the companies that has actually kind of successfully done that is Amazon, but they kind of continually traded around that 60 forward PE ratio for a number of years. For SoFi being a bank, I think that valuation is a little bit of a stretch, but we could see a stock price at that point between $33 and $40 per share. And this is really what I mean by we could see SoFi over the next couple of years kind of start to cool off a little bit. If it grows to around $40 per share, that would be about 40% growth over the next year. But I think this growth could occur over the next 1 to 2 years, and we could see a little bit of a drawdown in terms of their valuation as they kind of start growing into some of these numbers. And that's why, in my opinion, right now, SoFi is just a hold. I am still holding it within my YouTube portfolio, which is this one you're looking at right now. The value of this portfolio is currently sitting at just over $85,000. And SoFi is my fourth largest position in this this portfolio, I hold 200 shares for a market value of $5,300. My cost basis is only $1,200, so I am up over 340% on this position. The positions I've been focusing on buying more into have been healthcare related companies. United Health Group, I have 24 shares of, up 23%. Oscar Health, I have 225 shares of, up almost 40%. And then one of the positions that I've been adding to the most recently has been Novo Nordisk. I hold 55 shares. Right now, it's actually down 1.64%. So this is a position that I continue to build out because I think in 2026, we are going to see a very strong turnaround in this industry. But of course, don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. Thank you guys so much for watching. Let me know in the comments section, do you hold SoFi and what is your price target for 2026? And while you're down there, drop a like on the video and subscribe for more videos like this one. And as always, have a wonderful rest of your day.